Hi, everybody. Thank you so much for taking the time to listen in to our State of the Markets 2026. We like to kick off every year with just kind of checking in to see what's going on in the world of finance, markets, and investing. And Bepin, I think we've learned the hard way to not do this on January 1. I think it's a very, very good strategy to kind of give the year a few weeks to get a sense of what's really going to happen, right? That way we don't kind of roll in because there's always something that happens in January, always something weird that you don't expect, and then it kind of sets the tone for the rest of the year. And boy, I don't think this year so far is disappointed, right? We've got Venezuela, we've got Greenland, we've got Davos,
Yep.
more Greenland, right?
More tariffs.
So more tariffs, less tariffs, and it changes every day, right? So
Yeah,
now that
exactly.
we feel like we got some settling in, the market so far, knock on wood, has handled the first month of the year relatively fine. Let's get into the nitty-gritty. Great quote from the Raging Cajun, James Carville. It's the economy, stupid. I can't do the Southern accent or the Cajun accent like
Yeah.
him, but I tried. So nonetheless, obviously very famous, worked in the Clinton administration,
Yep.
and a storied legend in the economic ecosystem of sorts.
This is one of the most famous quotes out there. It's the first thing I think of when we talk about the economy. It's the economy, stupid.
Bepin, I'm a little bit older than you. But I'm not this old. There's a methodology, a design methodology that was invented in the 1960s from the U.S. Navy. Talking about stupid, the
Hmm.
KISS methodology, KISS, Kiss, keep it simple, stupid. It's a design principle, rather, basically asserting that most systems work best when kept simple by avoiding needless complexity. And I can safely say that few industries have ignored such sage advice in financial services. How many times have we seen an economic model that has like 100 factors in it that is
Hmm.
borderline impossible to understand? And I've always approached assessing economic activity by trying to take a first principles approach, but more importantly, asking ourselves what are the key drivers, okay? And really, when you look at the key drivers of the economy, we're looking at gross domestic product as a proxy for economic growth. There are four kind of drivers of GDP, but the two that matter the most are on the right: business spending and consumer spending. The two together comprise 87% of economic activity. It's going to the movies. It's getting a haircut. It's going out to dinner and getting a fancy bottle of wine if that's your poison. Right? What we do on a day-to-day basis drives the economy. So again, if I want to figure out what's going to happen in the economy, I really have to focus on how much spending are we going to have going forward.
And that's why, if you'll recall last year when we did our state of the markets, we just called it the state of the consumer. It is the number one driver of the economy and feeds into the markets. It's really how is the consumer doing?
Exactly. And I'm glad you said that, Bevin, because now that we know who spends the money, we got to ask ourselves two questions. One, can consumers spend money? Can they? All right, the ability to spend. And the second question is, do they want to spend? All right, that's more subjective. Okay, it's like, how do you feel right now? You might have money, but you might not want to spend it, right? So these are the two kind of questions that we assess when we're looking at the economy. And when we think about of the consumers out there who can spend, we got to figure out really who's driving the economy. And I think to me, I this is one of the more annoying things that I see in financial media. They always use this idea of like the K-shaped economy just showed up randomly or magically,
Yep.
where the top part of the K are people that are doing well, or the part of the economy that's doing well, and the bottom part are either the consumers or the parts of the economy that are not doing well at all, and how there's always this divide going on. And I hate to say it, all right, I think this has been going on for more than just like a year. I mean, I would argue that the
Decades.
K-shaped
Yeah.
decade, 100%. I totally
Might be
agree.
centuries.
I mean, it could be, yeah,
Yeah.
right. Which is why one of the reasons why we talk about a wealth gap and things of that nature. So, but for mathematical purposes, we do need to assess who in the economy matters more from a consumption perspective, and really that's going to be the driving force. So there's a statistic here or an equation that I want everybody to remember, okay? That has the top 10% of the economy, or the top 10%, excuse me, the top 10% of consumers rather, okay? And net worth, earnings, however you want to look at that. The top 10% drive 50% of consumer spending. The top 1% drives 20%.
Yeah.
All right. The wealthy
I
pay
know
the most in taxes and they spend the most money. So when I think about it just from a pure analytical perspective, if I want to figure out where the economy is going, it is critically important for me to understand, can the top 10% spend and do they want to spend? And that's where we want to put our focus. We're not going to ignore the other, call it an 80 or 90% of the economy. That's not what I mean. But because their weight of spending is so high, it's critically important that we figure out what this cohort is dealing with right now.
And I'm glad you mentioned the K-shaped economy and how they're talking about it as if it just showed up last year. This is stuff that we've talked about for years now. We may not have given it a acronym with the K-shaped or anything of that nature, but we talked about it, I know, as early as January of last year, talking about that the higher echelon, the 10, the 20%, they saw their savings increase. They saw their assets skyrocket. And what did that lead to? Outsized spending. And this is nothing new. It's time to get highlighted in the financial media. So the first question that we want to look at here is, can we spend? And as Mike alluded to, this is much easier to quantify. This is hard data. Is money accessible? Is it affordable? And how profitable is your spending? Like, how much can you make from the spending that you're doing, especially on the business side? And we'd say that all those are good to high. Now, obviously, affordability, you look at that and you say, good, what happened to all the inflation we just saw? Now, inflation did occur. Assets or cost of goods did increasing with cost of services, cost of labor, but we started to see that normalize. I think the CPI finished at sub 3% last year. We don't see much of a reason for it to really pick up. So affordability from this standpoint is good because think about it. Obviously, prices went up too, but so did assets. You look at 23, 24, 25, and we're one of the nicest stretches in stock market history. So we'd say overall, the ability to spend is high. People have money, at least a certain portion of the economy does, and they're more than able to spend. But what matters more is real wage growth. So the lines you're looking at here, the yellow line is the average hourly earnings. This is a 6-year rolling change. And the blue line you see is CPI. And as you can see, the yellow line has constantly stayed above the blue line. And you wonder, well, then why was the inflation in 2022 so bad? How come it hurt so much? Well, the reason I'd like to highlight here is that belly. If you can see my mouse on the screen here, look how wide that divergence was in the 2019, 2020s, and 2021. It was your wages were increasing so much faster than your expenses. You just felt richer than you ever have. And then inflation heated back up. And the reason was obviously a lot of money printing. And that caused, even though your wages didn't, let's say, grow slower than inflation on a rolling average, it just was growing at a slower, faster pace. If that sounds, if that doesn't sound weird, but basically your cushion that you were having between how fast your wages were growing versus CPI just shrunk down a bit. It didn't get evaporated. It just got trimmed down dramatically. And we've been seeing this for the last 2 years here. We're still maintaining a average hourly earnings increase over CPI. So people are getting richer. They're just not getting as richer as they were used to for that 3-year period there. So the next thing we want to take a look at is, do we want to spend? And this is a little trickier. This is soft data. Soft data meaning it's more feelings survey based. It's subjective and it's fleeting. So the first thing we look at is consumer confidence. And the more confident consumers are today, the more that they are going to spend tomorrow. Not all spending is equal in the eyes of the economy. Confidence matters more for those who spend the most, in which, like I said, the top 10% make up 50% of the spending. So yes, what we say, like the 60, 70% of the population feels good about their finances right now, probably not. But the people that make up 50, 60% of spending, they do feel good. The reason being, and we've talked about it before, the wealth effect. High income earners have seen their assets balloon during this time period. And then the next thing we take a look at is the small business happiness. So one thing to keep in mind is that you see these headlines all the time, especially recently here about UPS, Amazon, these large employers. You see them announcing 30,000, 10,000 layoffs, and you think, wow, that's a lot of people, right? One thing that they don't mention is that majority of people in America, they work for a small business like ours, a small business like many of you probably work for as well. The majority of employment occurs at the small business level. So how do they feel? They feel pretty optimistic. I think post 2025 election, if I'm not wrong, Mike, they had a record high in small business confidence in spending for the future. Now, obviously, the trade uncertainty that arose during April and may have, like we said, subjective and fleeting, right? So that changed a bit during that 2, 3 month period. But overall, we'd say spending is expected to increase on the business level. Businesses are investing in the future, whether it's via AI, whether it's data centers, whether it's buying a new or opening a new factory, opening a new branch. Businesses are expanding. And then lastly, we look at financial assets. And again, the wealth effect. Financial assets are an all-time high. It's hard to find an index or an asset class that isn't near or at an all-time high right now. So overall, we would grade the do we want to spend at high? Now, of course, that could change at the drop of a hat. That could change on a tweet. That could change on a any sort of panic moment in the markets or in the economy. That can change overnight. But as it sits right now, we would say that do people want to spend? We'd say yes.
Bepin, I think you brought up a great point around soft data, right? It really is how do you feel, and I think in many instances, let's be honest, a lot of people just lie. They do. They just lie.
Yeah.
Or they don't know, right? So I find that this data to be very difficult to work with. You said that perfectly. But I would say of these three, the one that it has, in my opinion, that lies the least, I guess, is the
Yep.
financial assets
Yep.
component, right? When asset prices are higher, people might mope or walk around and be like, oh, the person I don't like is in the White House, or I don't like where this is happening, or I don't like that's happening, I'm watching too much news. But ultimately, if that bank account is rising, that negativity doesn't last for long. Why? Because we are Americans, and Americans do one thing really well, and that is spend money. So when you think about, okay, so we've talked ad nauseum almost at this point about
Trade
spending and the
war.
importance of spending, right? So the question then becomes, what are some of the near to long term, sorry, near to medium term rather, drivers or tailwinds that could push consumer spending and business spending forward? I think the big one here, and a lot of people might be raising their eyebrow right now, the trade war uncertainty is fading. Now, we talked extensively last year about how we were less concerned about the inflationary aspects of the tariffs. Okay, now there are other issues with them specific to inflation. There was a lot of craziness, Liberation Day, we go on and on and on, right? Now, this year, I'm not saying that's gone away. If anything, this whole Greenland fiasco the last couple of weeks, we've seen that they've kind of been reintroduced into the rhetoric. But notice what happened this when they came back into the rhetoric and came back to the news flow, it didn't cause another Liberation Day 2.0 or anything like that. All right. There really was virtually no volatility. So
Mhm.
I think that uncertainty being off the table is not just good for the markets, it's good for CFOs and big CEOs of companies saying, you know what, I have a pretty good idea of what the future looks like. Over 90% of our trading partners we have right now, we've got to do some type of a trade agreement with either through tariffs or some type of avoidance tariffs. That's done for the most part. And I think that certainty bringing back to the C-level suites is good for spending. I also think that there are some massive tailwinds coming from not AI, artificial intelligence, not specific AI, but the ecosystem around AI. So data centers, the utilities to keep these data centers running, everything you can imagine around that. So just look at the chart on the right-hand side to give you an idea of the scale. These are not projections going into 2025 to 2028 on the right-hand side. These are actual data centers that are under construction and those with some type of active permit application. So this isn't pie in the sky, some McKinsey Institute trying to guess what's going to happen to data centers. This is actual, real, hard data. All right, so these are the data centers that are coming on. There's a ton of work around this from an economic perspective to get these data centers up and running the way we're going to need. And this is very, very encouraging for investors. Well, we've said it. Now, Bepin said it. I reiterate it. I'm going to say it again. This wealth effect is a really, really big deal. When our pocketbooks are going up and our house prices are going up, maybe stock portfolios, bonds, all of that, we feel so much better about the future. And look, I would say that every dollar that we spend, that we don't spend at the pump as consumers, every dollar that a company doesn't spend producing plastics or packaging or whatever materials require oil, that dollar gets allocated somewhere else in the economy. It is that simple. So I've always viewed oil prices as almost like a weird pseudo tax on consumers and businesses as they rise. Oil prices, look, Trump said it a year ago, drill baby drill. We've started to see some of the impact of these decisions. I know there's a lot of talk about Venezuela out there. I'm highly, highly skeptical that Venezuela is going to provide any near-term tailwind. In fact, I'd be willing to bet my house it won't, at least for the time being. But I don't think we need Venezuela to get oil prices down further. Even if they stayed where they are right now, in my opinion, this is going to be a pretty strong tailwind for consumers and businesses. And lastly, look, we don't do politics here, so don't send me any hate mail. But look, I think it's very evident right now. The Trump administration wants a white hot economy for a variety of reasons. But it's the problems that we have in this country. A lot of them can get solved through austerity is the first one, which is very politically virtually impossible to do, or grow so fast that these problems become rear view mirror issues. And from what I'm seeing in my seat, Trump wants to take that approach. So he is going to do things not because Republicans think it's the right thing to do, not because free market capitalism says this is what you should do. He's going to do it because he wants to run the economy white hot. And I think a lot of these initiatives will actually drive consumer spending going forward.
So we talked about the tailwinds, but obviously we got to look at the other side of the coin here, which are the headwinds. What are things that could kind of challenge the U.S. economy and the U.S. markets this year? First, which has probably been on the list 2 years now, a lot of people have a lot of student loans, and those are coming home. People have to start paying, and I know that they gave them a little bit of an extension recently, where they let them get out of garnishing their wages right away. But that will eventually start, and that could definitely be, remember, we're talking about consumer spending, and yes, the top 10, 20% probably aren't too inundated with federal student loans, but the rest are. And even though they don't make up the majority, if they do meaningfully pull back in spending because of these student loans, that will affect the GDP numbers. The next is obviously, it goes hand in hand with that, the K-shaped economy. It's if the bottom leg of the K meaningfully lower spending, they will impact GDP. There's no way around it. Yes, the top 10, 20% make up 50, 60, 70% of spending, but that other 30% is needed. And if that gets meaningfully cut back, that will affect GDP, which will affect the markets, which obviously feeds everything else. This has been on the headwinds list probably for decades now. But now it's gotten a little bit more out of hand. I think we talked about it a while ago that eventually the interest payments on the debt will cross $1 trillion, and that has come and passed now. It was a math formula. It wasn't a prediction by us. It was just looking at the debt and looking at the interest rate on it and being like, this is going to cross $1 trillion. And not only that, is the size keeps increasing. We keep upping the budget, and DC spending like drunken sailors. Everyone loves talking about, well, we'll eventually get this in order. We'll eventually get this in order. In the long run, we'll get this down. When is that? I've heard about the long run for the last 10 plus years now, where it's in the long run, this will all get sorted out. Eventually, the roosters will come home to, or what's the term there? The chicks will come home to roost.
Like
eventually we will have to pay the piper here. So that if the spending keeps getting out of control, this is where you could see some interesting moves in the bond market. Now, if AI, other areas come in where we can increase productivity or lower costs of goods, that will change the scenario. Number four is the job market. Obviously, that AI being a concern there. That's anytime there's a new general purpose technology, people are like, well, what happens when it replaces me? So the job market's something we keep an eye on. Obviously, like I mentioned there with the Amazon and the UPS layoffs, and those are just a couple. Obviously, there's other companies that have announced it, but we're starting to see some larger announcements. Again, the real place we'd want to keep an eye on is the small business market because, again, majority of people are employed by small businesses. So if we started seeing a lot of mass layoffs or large, I guess they wouldn't make announcements of it, but if you start seeing that unemployment number start to creep up in the data, that is not a good sign. And lastly, it's the housing market. They talk about this all the time. They want to bring the cost of housing down, and I think Trump even at Davos said the quiet part out loud is one way to put it, where he could bring the cost of housing down, but it would come at the expense of people that own houses. And that's a very sticky political situation where it's what you mentioned earlier, Mike, which austerity almost, taking from the haves and giving to the have-nots. So by lowering the price of housing, you're going to hurt people that already hold houses. And it gets very tricky to lower the cost of housing without really messing with the mortgage rate. Mortgage rates aren't set by the Federal Reserve by any means. So when people think like, oh, I see rate cuts, how come the mortgage rates aren't coming down? They're not setting the price of your mortgage based on the overnight borrowing rate. They're basing it off of a 10-year bond, and that has a lot more variables than just what the federal interest rate's at.
All right, so if we want to summarize this, because we've gone through a lot, and again, we try to keep it as simple and as straightforward as possible. I think you're right, Bepin, there are headwinds, there's no question, but there are always
Yep.
headwinds, right? There's always
Hmm.
tailwinds. I got to ask ourselves, which are stronger and which will last longer? And I do believe that the headwinds, or the tailwinds rather, are stronger and will last longer, simply because the ability and the willingness to spend look incredibly strong. Um, we we've already talked a little bit about. It's funny, inflation's kind of fallen off the radar to a certain degree, but we still need to consider it. And I would say that last year we were adamant that we didn't feel that there would be sustained inflation from tariffs.
Hmm.
That comes
Yep.
from money printing. It's a supply demand issue. And I'm not saying that we're not printing right now, far from it. But I don't necessarily view a major inflation risk something that we are going to um, strategically position ourselves for, at least not in the near term. Who knows what we'll be talking about 12 to 18 months from now?
I mean, even the Federal Reserve Chair, Fed Powell, you got to assume he's trying to do Trump no favorites after all the recent saga they've had. And he even came out and said we're looking at tariffs as a one-time inflation if there is any surrounding it. They're looking past it, which we believe is the right view to have.
I think the other thing too is that we are expecting short-term interest rates to be lower. Now, let me be very clear, not all interest rates, short-term interest rates, okay?
Yep,
Again,
exactly.
one of the things I'd be willing to bet my house on, I've said this before, I'll say it again, is that 1 year from now, interest rates, the ones that the Federal Reserve can control, will be lower. There's virtually no shot that Trump's going to put anybody in that seat once Powell leaves in late, I think, May, uh, that's not going to align with him. And he wants rates down. Now, is that going to affect mortgages? Is it going to affect the 10-year treasury? I don't know. That's a harder conversation to have. But short term, we feel that will be the case, and that's going to drive down borrowing costs for companies and other types of potentially consumers, which should ignite economic activity. But Bepin, you said it. You said it well. Housing is probably going to remain a burden for some time because you want to know why? It's been a burden
Supply
since
issue. Yep.
2005. 20 years
Hmm.
now it's been a burden. All right, it's a supply. You're exactly right. It's a supply side issue, and that is something. Look, 40%. Here's not a fun fact, but a fact for the day.
Yep.
40% of construction workers left the industry in 2008 and never returned. That's a problem.
We haven't been building anywhere near the size that we need to. And the number two is we're not building affordable housing. It is a mess. And yes, it's affordability issue, but it really comes down to a supply issue. There isn't enough of supply of when you look at that median average price of a home, there isn't enough supply of those houses that are actually priced at that median. So even if building rates, if you see that they start creeping up, it really comes down to what are they building? You know, do we need more McMansions or do we need more $300,000 to $500,000 homes, which is that sweet spot for middle America?
And let's go back to the K for a second here, Bepin. I think, and the math behind it, like we said, a small portion of consumers drives the majority of consumer spending. Okay, and that's that top part of the K, the
Yep.
top, 10%, whatever you want to call it, drives and determines the economy. But you know what? The bottom part of the K determines elections. Okay, so
Exactly.
if you have 90% of the consumer base down there, and I don't think it's 90, but it's some percentage that's very
Sure.
large.
Closer to 90 than to 10, right?
Correct,
Yep.
exactly. Guess what? We all have an equal vote because of democracy.
Mhm.
So the math would tell me there that the bottom part of the K can determine elections if they choose. And right now, why does Trump want to run the economy white hot? I think he has not a singular focus, that'd be impossible for somebody like Trump, but he has a very, very strict focus of winning midterms in November. And I think you're starting to see reasons like, or start to see strategies like capping interest rate on credit cards, buying 200 billion in mortgage bonds for Freddie and Fannie Mac, which by the way won't do anything. You're seeing a lot of things that might not be quote unquote Republican ideals or free market ideals. He doesn't care. All right, his administration wants to win in November, and I think they're going to continue to do things to make the bottom part of that K better off. Now, will he succeed in everything? I probably not. I don't know, but I do actually feel like a lot of initiatives that he could put on the table will help the bottom part of the K. And again, pushing politics aside, if if his administration is successful, then that should theoretically translate to more economic activity in a very short amount of time.
So switching gears a little here, we focused on the economy. Now let's take a look at the financial markets. We're opening up with a quote, as we always do. This one is from Henry Paulson. He was the former CEO of Goldman Sachs and even worked as the Secretary of the Treasury under the Bush administration. And he said, one of the most constant aspects of American life is change. And nowhere is it more evident than in our financial markets. And I don't think any truer words have ever been spoken. It really fits with the evolutionary nature of markets. First thing that really popped to mind when you think about evolution of the markets is AI. And obviously that has caused some worries. Technology shifts, reallocate labor. And the chart you're looking at here is actually really interesting. It goes basically all the way through the 1770s. So I don't know how accurate the data is, but it makes a lot of sense, which shows that firewood as a share of US GDP from 1974 to 1920. If you look at this, firewood at one point was almost a quarter of the US economy, just chopping up wood for people to use in their log cabins, I guess. But that made up 25% of economic activity. And then what happened when kerosene, and I believe what John Rockefeller was the first introducer, or not the inventor, but the one to bring it to mass appeal, where people no longer needed to burn wood, they burned kerosene for light and other sources. Um, and look what happened. The share of firewood slowly came down. So what did all those wood choppers do? Did they all crawl under a rock and just die? Or did they find another business? Did they find another avenue of economic activity to replace their income and keep the economy moving forward? And are we not all better off from it? Is it better off if we were all still chopping wood today just so that we could have kept it at 25% of our GDP? I promise you we would be a third world country today if firewood was still a quarter of our economy. So advancements, while they may be painful in the short run, over the long run, they benefit everybody. And that's what will we think AI will look at a similar story. Like every other general purpose technology, it will displace some people, but they will reallocate to other profitable sectors of the market. And here we're talking about the AI adoption. It's already happening. It's more than just making memes. I'm sure we've all seen those on social media and whatnot, those AI generated videos. And yes, we all get laughs, but it's not just for jokes and not just for making your favorite Disney character do something that he normally wouldn't. But this is a share of US businesses with paid subscriptions to AI models, platforms, and tools. And if you can see across the board, besides the US government, everybody is increasing.
Shocker, by the
Yeah,
way.
exactly. They're always a little behind the curve, but everybody else is adopting AI or entering the AI space. We have it at our firm, obviously. Um, you need to. It's adapt or die. That's the only way to move forward. And along with that, not just that are people adopting AI faster, more businesses are starting to use it. The AI models themselves are becoming dramatically better. That chart on the right you're looking at is the AI software engineering task complexity. So it's looking at how long it would take a human to do tasks to do a task, and then comparing it to how long would it take, or how many hours can an AI model save, essentially. So when you look at that big J curve going up, ChatGPT 5 can complete a task at 50% accuracy that would have taken a software engineer 2.5 hours. And the output probably comes out in less than 5 minutes. So this time reduction, the savings and the workload and the ability for that AI engineer now to really just work on quality control and have more time for other profitable tasks within the business have exploded. So overall, we do expect AI to meaningfully begin to add to earnings and add to GDP growth. And obviously, when things, just like every other general purpose technology, everyone wants to know, is it a bubble? And AI is moving fast. These new models come out like every 6 months now. Every few months, you see Chat GPT 6 will be out at some point. But what we're also seeing is that yes, the AI technology is moving fast, but are we getting our money's worth today, right away? And this is surveying a bunch of different CFOs at different firms, asking them how is your firm, how has AI affected outcomes at your firm? And yes, there are plenty of readings on the right side where you look at increased whatever it be, whether it's labor productivity, decision making, speed and accuracy, customer satisfaction, time spent on high value add, besides the point. But you'll see that there are some that increase from 1 to 5% or increase by more than 5% in various different categories. But the vast majority, the real sticking point of this chart is the middle. Most are not sure and they don't see much change. So what we're seeing is a lot of increases in AI models, but we still haven't found perfect uses for it yet. We're still taking time to figure out, the businesses are taking time to figure out how to really implement it and to really start seeing the value add. So maybe, yes, AI is moving very fast, but yes, the usage isn't producing what people are expecting. So our expectations are through the roof for this technology. But you got to remember, when did ChatGPT come out, Mike?
For real, 2023-ish.
Exactly. So it's a 2 years, 2, 3 years
Yeah.
now. It's in its infancy still. So yes, obviously it's always easy to dream big and think that, oh man, we've developed a superhuman technology yet. It is not artificial intelligence in the sense of a sci-fi movie yet. This is just a really, really advanced codex system, essentially a predicting system where it can predict what you're looking for based off what you typed into that box. Now, will we eventually get to agentic AI that can think for itself, or AI that can think to the human level? I don't doubt it. The way things are going, the money that's being spent, the technologies that are being invested in, I wouldn't be surprised if it's in my lifetime that we do get to a point where the AI can do what a human can, or at least mentally, maybe not the emotion side, but at least like the task we work on. I do think at some point in our lifetime we'll get there. But point being is, yes, AI is moving fast. The tech is increasing rapidly. We're still not seeing it right now today. The economic advantages, or in terms of like the earnings growth or anything, that we're not seeing the benefits really match yet, but that is coming. And now looking at the international market, so looking back at what we saw last year, we finally saw international stocks rip. They caught up. If you look at this chart here, US large cap and small cap were towards the bottom right here in terms of performance last year for major equity markets. Majority of those markets to the left, Korea, Latin America, Taiwan, China, all those are considered international or emerging market or indexes or countries, and they all outperformed last year. And that actually led to a lot of the if you're in our passive models, that's where a lot of the outperformance over the S&P came last year, was being allocated to international markets, being diversified. And the reason we really pounded the table on that is because if you look at this chart over to your right here, this is looking at, had you just invested in the S&P 500 from 2010 to 2025, the cumulative gain you'd be looking at. And this is why people didn't own enough international. The average investor saw 15 years of S&P 500 US markets outperforming the rest of the world. And it makes it very tough to allocate to international markets when you've seen them not work for 15 years. But this is why we always remain diversified, because even when it doesn't seem possible, that the US will ever lose after having a 15-year just golden run, there are tide shifts. And that's why we always want to remain diversified, and we're definitely going to remain invested in international markets.
Bepin, I think about the concerns that we heard last year, regular concerns about the dollar, weakening, falling apart, losing reserve currency status, about how foreign investors were running away from U.S. assets.
Sell America trade, yeah.
Sell America. And there were like literally dedicated financial outlets, and they had like little acronyms, like you just said. And what happened? Well, here
they sold America for 10 days.
Maybe that, right?
Yeah.
Exactly. And if you look at the end of the year, we like to look at data here. All right. It's one thing to hear what's going on the radio or the TV or whatever it is. We look at data. And across the board, believe it or not, there was a higher demand for higher foreign demand rather for US assets last year than in 2024. It didn't go down, it went up. Now, not across the board. China did sell treasuries, okay, but Japan did it. In fact, if anything, Japan's still buying quite a bit. And across the board, look, people want to be here. Why? Well, we've got the best functioning financial market system in the world at scale. And we have a lot of entrepreneurship and innovation going on here. And our government, as screwy as it can be at times, it relatively speaking, tends to work fairly well. So
it's stable relative to other.
It's stable.
Look at Venezuela. They just had the head of their country removed. So very stable relative to the rest of the world.
So let's kind of put the rubber to the road to a certain degree, Beth. And I mean, I think that everybody wants to know what's going to happen this year, and we don't like to do too many forecasts around here. But look, past performance does not predict future returns. We know that, but a lot of times history runs. And I actually believe, as much as I'm a long-term investor, I've noticed just too often that if you do have momentum at the beginning of a year, even though it's not logical per se, more emotionally driven, it does tend to carry on through the year. I think that's the reason why this chart makes sense. Look on the left-hand side of this chart. This is going back to 1950, an quote unquote average year in the S&P 500. We've seen an average return of about 9.6%. That's that blue bar you're looking at right there on the left-hand side. Now, that golden kind of diamond thing above it, 72.4% of the time, that year has ended positively. So again, average return, 9.6% a year, 72% of the time, the index has been positive. That's a good, that's a great deal, all right? But if you look on the right-hand side, the reason why we circled this or highlighted this was because when the first 5 days of the month are positive and up by over 1%, I know that sounds a little specific, but follow me. So the first 5 days of the month, or the year rather, are greater than 1%. Look at the return. It jumps to 15.7% average annual return, mid-teens, with an average or with a return rate of 87% of the time positive. Take a guess where the first 5 days ended this year. Not too bad. Yeah,
I think a percent, 1.1% on the S&P in the first 5 days.
I think it was like a slight win. So look,
Yeah,
again, we're not saying that
cross
this
that
is,
barrier.
yeah, it's not a mortal lock, okay? These are
Yep.
averages, right?
Hmm.
But I think this is representative of that idea of early early year momentum kind of being carried in. And I do think there's good and bad with that, right? The good thing is that the momentum's there, people are positive. The bad thing, I think that was weighing in the back of my mind, I don't want to speak too much for you, Bepin, but I think you're probably on the same page, is that are too many people too positive?
Yeah.
I don't think so yet, but that's something that I think we are going to spend a lot of time trying to think about over the coming months.
And with that being said, obviously we want to temper some of those expectations, right? Obviously, yes, the first 5 days being at 1%, like Mike said, oh, we don't put a whole heck of a lot of stock to it because again, they're averages. But one thing we do put a lot of stock in is the market will go down at some point this year. It happens every year. The what you're looking at here is a chart of or a table of the S&P 500 index with looking over at various different declines and how often do they happen, what the average length is, and the last time it occurred. If you'll notice there was three different occurrences in 2025, and look where we finished the year at. So it is very normal and very expected. So one thing we always say, this is a feature and not a bug of a well-functioning market, which the U.S. is. So we would expect to have volatility. We would expect to see drawdowns at some point this year, just like we would in almost every year. If you look at a decline of 5% or more happens almost 3 times a year, 10% or more every 16 months, 15% or more every 3 years, you could expect one. And again, averages, so they could happen even more frequently. And then 20% or more, that happens about every 5.5 years. And these are the ones that really scare people. And these are the ones that tend to last a longer duration. As you'll see, they can typically last up to 335 days, so almost a calendar year there. And if you remember '08, that's a little longer than a calendar year. So we always want to make sure that we position our portfolios and we position our clients to expect volatility, to expect drawdowns, so that when you do see them, you don't think, oh no, what happened? Something crazy must be occurring. You just think that this is what the market, this is the market being the market. People are going to love this one, Mike.
All right, let's do it. What is going on? You've seen a massive rise in the demand for gold from retail investors. And when I say retail, I mean you and me, average everyday people, not institutions. So,
Yep.
I mean, there's a lot of theories out there about what's going on. To me, I feel like the biggest driver here are central banks. I got to think that's what's going on. So go back to 2010, that decade. I know a lot of people when I was working on Wall Street that were making a ton of money because the central banks in the world, like the Federal Reserve, would go on TV, like literally go on TV and say, we're going to be buying like, a couple $100 billion of bonds over the next couple months. And they would tell you publicly. And so what did my bond trader buddies do? They went out and bought bonds before the central banks did. So when the banks wanted to go to the market to buy, they got in front of them and they basically sold to the banks. Like they made a killing, an absolute killing. Are these the smartest people in the world? No, I wouldn't trust half these people to drive a car. But when you have like a massive entity like the central bank system saying we're going to do something, you get in front of that and you can make a lot of money. So I think that there's a component to that, what's going on here. It's the same thing with gold. The banks are buying up gold. They don't care about the price of gold. They're not looking to make money off of gold. They are buying gold because they've determined they want gold in their vaults. It's that simple. They are price insensitive. And when you have price insensitive people in the market, you tend to have these types of reactions. So again, there are other reasons why gold is taking off, but I think that the central bank influence is the probably the biggest driver. And remember, when it comes to the demand side of the equation, 92% of world demand for gold, retail demand for gold, 92% comes from India and China.
China. Yeah.
Those two
The
countries.
Davis. Yeah.
Yeah. And I don't want to be kind of a Cassandra here or a Debbie Downer, but let's be abundantly clear here. And let's all remember that gold is very volatile. Okay. Gold does not produce anything. It doesn't produce cash flows. It doesn't sell anything. It doesn't reinvest back into it. It doesn't buy back its stock. It doesn't pay dividends. It just sits there. Now, is that bad? No, it's fine. It is what it is. But gold is very volatile. And if you go back to the kind of the post Bretton Woods gold standard that was back in the 70s when we left the gold
Yep.
standard, I mean, we've had some like serious crashes. I mean, we're talking about like above 50% drops in price in a matter of months to years. So I'm not saying this is an imminent and this is definitely going to happen. My point here is that I don't think this ride is going to last forever, and I don't want to be around for when it falls apart.
And whenever you see a violent move, like 170% in an asset class that large, doesn't bode well typically for the long run. Like Mike said, we're not saying it's going to happen anytime soon, but I don't think it's a big stretch to say that at some point that it will reverse. We don't know how deep. We don't know if it'll be one of those 67%, 47% drops, or it'll be a little bit more mild, like the 2020 to 2022 at 20 some percent. But it's hard to imagine $18 trillion of value just got created in a year and a half. And that's about the gold market grew to in a little bit over a year. So something to keep an eye on. If you have gold or you're holding physical gold, not the worst time to potentially go and talk to one of those gold dealers. It will pay a spread, but maybe locking in some gains. Shifting gears here a little bit, looking at a diversified portfolio. And this is really the reason why we diversify. So the chart you're looking at is on the left-hand side showing a 60-40 portfolio in 2019. And on the right-hand side, you're looking at what that would have grown to in 2025 had you not rebalanced at any time along the way. And had you not, you'd be sitting today at an 80-20, essentially, probably taking far more risk than what you really intend to, just because if you were at a 60-40 in 2019, you're probably a moderate to moderately conservative investor to now all of a sudden you're holding 80-20, which would be considered an aggressive account. And this is one of the reasons we're always pounding the table about rebalancing, selling our winners to buy our losers. It is prudent investing because if you don't do it, you will end up with a portfolio you did not intend to have. And it's all fun and games as everything goes up. But when the tide goes out, we find out who is swimming naked. I think that's a Warren Buffett classic proverb there, where only when the tide goes out, we find out who is swimming naked. And if you're
Great quote.
letting exactly, and if you're letting your stocks dominate your portfolio due to the incredible run up in the Mag 7, you may be taking a lot more risk than you think you are. And that's why throughout last year you saw us taking gains off the table, not shifting so much to a defensive posture, but just getting it while the getting's good is essentially the layman's term of saying it. So where when you see things running, when we know we have a risk allocation where we want to stay around the 60-40, we cannot allow things to drift to an 80-20 or even higher in some instances. We have to rein ourselves in. There's two driving factors in the market, fear and greed. We can't let greed overcome us. Lastly, it is the bond market. Now, this is last year was a fantastic year for bonds. But obviously, the previous 5 year period before that was considered a bond Armageddon. Historically, there was the famous quote that a bad year in bonds is a bad day in stocks. Unfortunately, for most of history, it did work. Obviously, diversification worked. If you look here from like the late 90s all the way to 2020, it worked. And then you had a basically sea level change where we went from zero interest rate policy to 5.5% on the federal funds rate. And all of a sudden diversification didn't work. Your bonds and stocks were down in lockstep. Now what was nice to see last year was when we did see some periods of panic in the market, the bond market or in the stock market, the bond market actually held up. And I think the ag finished up the year last year at 7.5%, which fantastic return for fixed income investors. Um, so that's why we're very comfortable with having a larger bond allocation in some of our active models. It's bonds that I know we've talked about in the past. Bonds are math. They're very math based. They're not so much predicting the future. All you're looking at is what your starting yield is. It has like a 93, 95% correlation with your 5 year average return. So if yields are at 5 right now on the ag or on any sort of bond index you're looking at, your return over the next 5 years, 92, 95% of the time is 5%. And I know that doesn't sound great, right? 5% relative to the market doing 15% on average for the last 10 years. But again, averages work. If you have a bunch of years above average, chances are there will be some years in the future that will get you back towards that long-term average. Um, So not a bad time to be increasing our bond allocation. And again, as Mike said, we do expect rates to be lower. Will that affect every portion of the curve? No, but it will affect at least the front end and the medium end of the curve. We do believe that we'll probably get more than the one or two the market Keith is certainly thinking right now. Like Mike said, Trump's going to appoint somebody that's very, very aligned with his view on interest rates. And if you go by some of the truths or some of the tweets, that view is at the 1 to 2% range, which would be far more than two interest rate cuts on the year. Now, again, doing things like that could affect the Fed credibility and things of that nature. So we're not saying that we're going to get down to 1 or 2%. That could be a little crazy, but we do expect rates to come down. And in our opinion, it would be more than two, and that will help pick up some price return in fixed income. Will it help the long end of the curve? That is to be seen. So our plan for this year is obviously plan for lower rates and a white hot economy. I think Mike hit the nail on the head there when he was talking about this is a midterm election. This is key that he helps out the bottom leg of the K curve there to secure an election. So they will be trying as much as they can. Whether they'll be successful, that's to be determined, but they will be trying their very best to run the economy hot, as most politicians do when they're going into an election cycle. So is it good or bad? We're not saying anything about whether the merits of doing something like this. We're just living in the world of reality where we need to position our portfolios for what we think will occur. And we're going to believe him when he says he wants to run the economy hot. What we're going to do to stay prudent as investors is take profits when the opportunity presents itself. So even though we know it's going to be maybe a potentially hot economy, we want to make sure that we're positioned for what any blowback that could happen in the future from doing some of these, I'd say quick fixes of like 10% credit card interest, buying mortgage-backed securities, telling investment banks that they can no longer buy single-family homes. Those could present problems in the future. So what we want to do is make sure that we're taking profits when we can. As always, we are going to remain diversified. We are going to always preach diversity. Just the reason being is you can never predict the future until it's already happened most of the time. You never know what's around the corner. So staying diversified, being invested in all asset classes is a prudent form of investing. As always, we expect the markets and investors to get tested. That's why we make sure to show you. I know we didn't include it in this one, but we always show those charts of the S&P annual return at the end of the year and the largest drawdown throughout that year. And there's always some big red scary dots all the way down at 10, 15%. But usually on the average year, they end up green. The market is up by the end of the year. So we would expect that to continue. It's not a bold prediction by any means. It's the nature of the markets. It happens almost every year. And with that, we would like to thank you for tuning in. As always, if you have any questions or concerns, feel free to reach out to us at any time. We look forward to seeing you again, hopefully in the next couple of weeks here, where we'll get back to the Market Pulse regular scheduling of current events and drivers of the market. So thank you and have a great weekend. Bye.